What's going on, guys? Welcome back to another video. So throughout 2020, we saw the stock market do some crazy things. In March 2020, we saw it came down extremely low to almost record lows for many companies. And then throughout the rest of 2020, up until just recently, we saw the stock market increase and increase and increase. The prices went up and up and up. Many people thought this was going to be a never-ending uptrend. Well, all of that changed recently when many investors started to worry about the 10-year treasury yield. They started to worry about possibilities of inflation, and then they started to worry about this $1.9 trillion stimulus package that was recently passed by the Senate. Even though people like Federal Reserve Chairman Jerome Powell came out and told us almost every single week that, hey, do not worry about the interest rates, do not worry about inflation, do not worry about any of this stuff. We will keep printing money, do not worry. He even came out last week and didn't really tell us that inflation isn't coming. He said inflation will come, it will show its ugly face, and then it will slowly go away. It's going to come and go as it pleases, but do not worry. Well, even though he said this, many retail investors and institutional investors as well started to worry and were thinking, can we believe him? Well, many people decided, no, we can't. And that's one of the reasons why the stock market started to sell off. But is that the only reason why the stock market started to crash? Well, maybe, but actually not. There's more to it. What we know is the stock market is starting to crash for multiple reasons. But are we at the beginning, the middle, or the end of this crash? Well, I'm going to address that in just a minute. One of the reasons why the stock market began to sell off is because many investors believe that we are at the end of this pandemic. We are at the end of this kind of, stay at home, don't travel, don't spend money, don't go to restaurants, and don't do all the stuff that we normally did. And so because of that, we aren't seeing a complete crash because some of the stocks in the recovery sector, like some of the airlines, restaurants, and things like that, they are actually seeing an increase. These prices are going up. So it's not the entire stock market that is selling off. Yes, in some cases, and mainly in technology, in the tech sector, that's doing very bad, but that could be a good thing. Others say the tech sector was just overvalued and that it needed to consolidate and come back down to more manageable levels. And if that's the case, great. I think that's perfectly fine and that's healthy for the markets. Some experts say that one of the reasons why we're seeing this sell-off is because this was due to the fact that many retail investors like you and I, we have, excess cash sitting around in our bank account, in our Robinhood account or Webull account or wherever, and we are just making trades for the sake of making trades. And that could be part of the issue. And then you got others that say, no, it was because of the Wall Street's Bets Reddit community that ruined everything for the retail investors. Now, yeah, some people did lose money because of GameStop, AMC, and BlackBerry and things like that. But again, trading and investing in the stock market is not a guaranteed way to make money. Now that we got to that, what is the real truth? What do we know about the stock market? And are we going to see it start to go up anytime soon? Well, I have some answers. In my honest opinion, I think what happened is very natural. We've seen it happen many times throughout the past year. We've seen it happen many times throughout the past decade as well. So some companies, yes, they were overvalued and they had to be corrected. And I think that's what happened. We also know other companies are undervalued and this is what's going to push them up and up and up. These are the companies that you need to be invested in. But what is currently overvalued? What's currently undervalued? Well, that's going to be for a different video, but let's get back into what you need to know for this video. One of the things that we have seen recently is many institutional investors, so big companies, hedge funds, people like that, they are worried that they have to secure their clients' money, their profits first. So here's what's happening. I just want to be 100% clear with you guys. This doesn't mean you have to go and do exactly what the institutional investors are doing. I personally am not, simply because I am not an institutional investor. I don't have to secure profits for millions of other people. I just have to secure the profit for me. So here's what's been happening. We are seeing institutional investors pulling money out of things like Tesla, Apple, Amazon, right? Bigger companies to secure profits for their clients. Then they're taking that money, they're putting it into things like cryptocurrencies like Bitcoin. They're taking that money and putting it into things like even the 10-year treasury yield, to the bonds, right? They're doing that because they want to almost guarantee profits as opposed to risking their clients' money. So on February 25th, when we saw the 10-year treasury yield rise to over 1.5%, it just made sense for institutional investors to pull money out of other companies and put it into bonds because their clients pay them to almost guarantee a certain percentage of return. And if they're not getting that, the clients are going to take their money and put it elsewhere. So these institutional investors cannot wait to see the companies drop, and then their clients are wondering, okay, why did my portfolio drop to this much? They're looking at the whole picture. The institutional investors are like, okay, don't worry, it's going to go back up. Well, the client's like, no. I don't want my money in that company because it just keeps dropping. Why don't we put it over here? And if the institutional investor is not going to do that for their clients, what's going to happen is the clients will take their money, pull out, and they'll run. This is exactly what happened to Cathie Wood's company, ARK Innovation, simply because a lot of the money that was going into the ETF, the client started to pull it out, simply because they didn't agree with how she was trading and what their company is actually doing. Me personally, I like what Cathie Wood is doing. So let me just give you a quick little example. Why would a person, let's say myself, I'm going to go invest, say $100,000. I'm going to give it to some, company, and they're going to go invest it for me. They're an institutional investor. I'm going to give it to them. Great, go invest it for me. Perfect. Well, why would I want them to go and take my money, put it into a company like Intel, for example? Intel pays, I think, like a 2.2% dividend. Okay, great, perfect. I'm going to get 2.2% on my $100,000 investment per year. All right, great. But what if the same thing happens again where we go through this pandemic and now Intel says, no, we can't give you 2.2, we're going to give you 1.1. We're going to just cut it in half. Or we have to suspend dividends this year because we've had a very tough year. Okay, I understand, but I want my money to grow. So what happened was when the 10-year treasury went up over 1.5%, what a lot of people were doing was like, why don't I just take my money out of Intel, for example? Why don't I just take my money out Intel at 2.2% and go stick it into a 10-year treasury, which almost guarantees a 1.5% percentage, right? It just makes sense because that's almost a guarantee when Intel isn't really. So instead of risking someone's money, these institutional investors are putting the money where it's best used, where it's almost guaranteed to make money. That's their goal at this point. But when things start to move around, which it looks like we're already starting to see that kind of swing, as soon as that happens, they're going to start taking their money, they're going to start putting it back into where they pulled it from. And this is just the cycle that we continue to see. So here's what I recommend to you. First off, you just need to educate yourself. Don't sell out all your stocks. Don't sell out all your positions simply because you are worried that they're going to continue to drop. That's usually not the way the stock market works. Yes, we see a big spike, it comes back down, and it spikes again. It just keeps going up and down. That's the way the stock market works. It just works in cycles. So as long as you understand that, you're going to be perfectly fine. Now, if you're only trading to make money, you're going to buy something today and sell it tomorrow, and you want to guarantee income, that's not the way the stock market works. Sometimes you lose money, sometimes you make money. As long as you make money more often times than you lose, you're going to come out ahead. However, many retail investors are not that successful. So here's what I want you to do. Just educate yourself. And as long as you are invested in a good quality company and you stand behind that company, you should be fine. Don't sell out too early. Now, let me just give you an example of some of the things that I purchased this past week. For instance, over the past week, I purchased a good amount of shares in Tesla, and I purchased them at $598 per share. I think under $600 is an incredible deal for Tesla. I think Tesla is an easy $1,000 stock. Maybe this won't happen in 2021, but I think in either at the end of 2021 or the early to middle part of 2022, Tesla will break $1,000 per share. I also ended up purchasing hundreds of shares of NIO. NIO is a Chinese company, an EV company. They're a very good company, have an incredible car, and I purchased these at $36.01 per share. I think that's an incredible value. Anything under $40 for NIO, I think is an incredible value. As soon as it got to $35, I thought, buy, 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 buy. And that's actually what brought my price from, it was up over $40 per share down to $36.01. I also, okay, again, both of these companies, before I get to the next one, both of these companies are 5 to 10 year holds for me. This is not something I plan on selling tomorrow. This isn't something I plan on selling at the end of this year. I plan on holding both of these companies between 5 and 10 years. Okay, 5 to 10 years. This is my personal plan. Another thing I ended up picking up a bunch of ARC Innovations EFTs. I ended up picking this up at an average price of $112.40 a share. Now, this is the EFT that's run by Cathie Wood, who many say is our generation's Warren Buffett. So if you were, if you had the opportunity to invest in Warren Buffett when he was first kind of coming out and gaining traction, honestly, you'd be a fool to not invest into Warren Buffett. So, as if this is our generation's Warren Buffett, I'm going to stand behind Cathie Wood all the way. So, at $112 a share, I think this is an incredible deal. This EFT has really been beaten down by the stock market recently. A lot of people have just been pulling their money from the fund, but I personally, again, this fund was over $150 less than 1 month ago. I think it can easily get back there, and so I'm going to invest in Cathie Wood and the ARC EFT, or Innovation EFT, for the long run. This, for me, is another 5 to 10 year hold. I am not just a day trader or a swing trader. Yes, I'll do some day trades. I do a lot of swing trades. However, I am an investor. I plan on holding companies for the long term. Just to give you an idea, back in 2009, I ended up picking up 100 shares. Again, it wasn't a lot. In 2009, I was still fairly young. But in 2009, I ended up picking up 100 shares of American Airlines at $3.70 a share. Since then, American Airlines has obviously shot up. I think right now they're a little bit over $19 a share, so it's still a very good investment for me. But again, $3.70. You would be a fool to invest $3 or not invest $3.70 into American Airlines at this time. If you were able to do that now, that's a $19 share, $19 stock. It makes sense, right? So here's what I recommend to you. The first thing that I recommend you do is only invest money that you don't need, that you could potentially lose and you'd be perfectly fine. I hear a lot of people say, oh, I invested $1,000 of this money and now I need about 400 of it back to pay my rent. That's not the way the stock market works. Do not, ever, never, and I repeat, never, ever, 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 invest money that you cannot afford to lose. So here's what I recommend to you. Okay, first off, I just talked about that. The second thing I want you to do is buy the dips. This is something that a lot of investors talk about all the time. As long as you are buying the dips, and when I say buying the dips, you're going to see the stock market go up. Don't buy. When it comes back down and it's coming into a correction, or there's bad news, right? Whatever. You see it misses earnings and it starts to dip. Buy the dip. Buy that. Then it will ride back up. This is the way the stock market works. Now, here's what I suggest. Over the past couple of weeks, we have seen the stock market fall and fall and fall, and it's done that for about 2 weeks. Now, we did see a green day this past Monday, but do I expect that to happen again and again and again? No, I don't. I expect to see some big losses, which we've already seen, followed by some large gains to get us back to where we kind of once were. So here's what I suggest. What I want you to do is set aside some money. Let's say you set aside $1,000. Great. You set aside $1,000, this is going to be your ability to keep buying. What I suggest is don't buy in with 100% of your buying capacity. Buy in with 1/10. So if you have $1,000 set aside, every single day that you see a red day, you can use $100. And I say this because on average, we see a consolidation cycle of about 14 days. 10 of those days are trading days. You see how this works? So if you have $1,000, you use 1/10 because you got 10 trading days in there, that 2-week consolidation cycle. So because of that, you should be able to spend all your money that you have set aside to continue to average down. If you do this time and time again, as soon as we see that spike, as soon as we see that long run, which usually lasts months, when we see that, you could potentially make a killing in the stock market. Remember, nobody was ever 100% successful buying the bottom of the market. You cannot time the bottom of the market, and you can't do this over and over and over again with 100% certainty. So as long as you buy those dips, you will be fine. So here's what I'm predicting for this week. My guess is, again, this is just my guess based off of research, based off of past history, is normally when we see the House or the Senate pass a stimulus package, especially one at this magnitude at $1.9 trillion that the Senate just passed the other day, my expectation is we're going to have a green day tomorrow morning. I don't know if this will hold for the rest of the day, but my guess is we are going to have at least a green day to open the market, probably in pre-market, probably in, as soon as probably first hour or two, we're going to see green, 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 but then we could see it really level off. We might see it taper down into a red day. My expectation is we will have at least 2 out of the 5 days this coming week will be green. The other 3 would be red, or at least they'd be level. That's at least my expectation moving into this week. So just, use that information as you will, but just understand we could see this downturn quickly turn into an uptrend. If this happens, you want to make sure you're in on it. So don't invest all your money. Don't invest money that you can't afford to lose, but invest into companies that you truly believe in. So anyway, hopefully this gives you a better idea of what we've seen, why the market sold off, what we could potentially see this week. The good news about the $1.9 trillion stimulus package, the good news about, okay, we are slowly getting out of this pandemic. More people are becoming vaccinated. The markets are, yes, they were a little bit overvalued. Now they're pretty much consolidated. We should be able to see a little bit of an uptrend. Hopefully it goes and goes and goes and people make a boatload of money. But as always, if you have any questions whatsoever, please ask your questions down in the comment section below. I just want to thank you guys for watching. Consider subscribing so you never miss another upload, and I'll see you guys on the next one.